with me today, and we got some charts we want to go over real quickly. How you doing, Andy?
Good, Mike. Good. Thanks for having me.
Yeah, well, it's been another wild week in the stock market. The market was down last week, although on a Friday it rallied almost up about 500 points. And I think what's been going on, this has been the worst drop so far the stock market's ever had this quickly. If you compare it to past bear markets, including the one in 1929, the market has fallen faster than it even did then at that point in time, if you count the months and weeks forward. But I know, it's easy to get caught up looking at what the market does week by week and day by day, and most people I know are just holding on and hoping for signs of a bottom, while there's other people who are in cash or whatever, and they're also fearful that they're going to miss out, or that they see opportunities to make money in the market here and there. And just the fact that you're looking at it and watching it fluctuate all the time makes you want to trade or do something. But I think these charts you sent me really are interesting to look at to try to get a bigger perspective on things.
Yeah, I put together some charts of the market that we're seeing today, and then some of the bear markets that are all the way back to the Depression, and then the bear markets of in the 60s and then the 70s. And all the markets, even though this one's fallen much faster, are the same. And
in what way? For instance, let's look at the last bear market from 2000 to 2003. How do you think that's the same as this one?
Well, the outcome is if we're going to get to a point, and believe it or not, I mean, a lot of people, I know we were talking just the other day, and I hope this clarifies things a little bit. You were just saying, Andy, I just don't know when this thing's going to bottom. Yeah, the market has fallen 55% from its highs, and it's been, it's straight down the past 2-3 months. But that doesn't mean the market's going to fall another 20-30%. I mean, the markets are a little different now. In every bear market, the pullback from its highs to its lows, some were a little quicker than others, and some took a little, more time. But even though the market's fallen extremely fast here, and that doesn't mean that it's going to be 2 years before this market bottoms out. And the charts that I put together, I was using on the charts here, I'm using a 150-day moving average on all the charts. And I want us to go through these charts and it'll help me better explain how we're going to make money, how this is going to end up being one of the best opportunities maybe that we'll see in the next, probably the next 15, 20 years. It's going to be the evaluations and where we're going to be at as far as taking a position. It's going to be really good. So we don't have to really guess how far it's going to go. It's just, allow things to line up. So let's take a look at the first chart that we put up. We got the bear market from 2000 to 2003 in the S&P 500. And you can clearly see that if when the market was starting to break down and it made a top in 2000, it clearly broke down and broke its neckline right there, and fell really hard. The first really hard drop
in 2001.
Yep, right there.
Then jumped back up to the moving averages. That's kind of what happened in the first half of this year.
Identical. Okay, that's identical. And most all bear markets are not exactly identical, but they're very close. And a lot of I could get real cute and throw you 10 more indicators and 10 more different types of charts here of reason why how a market puts in a major top. And the same thing will happen in a major market bottom after a bear market. And when we get to that point in 6 months or a year from now, when it's time to possibly get ready to go long, we'll talk about those a whole lot more. And but anyway, the top that you're seeing there in 2000 and then in 01 right there, where it completed the top and then it rallied back up to the long-term moving average. Number one rule of thumb: you don't hold stocks long when you're in that position. When the 150-day moving average is trending down, you're not long in the market. If you are, the odds are probably 90-95% you're going to lose money. And you see that continually, on through 01 and 02. And then right down in 02, 03, we saw the market start to base out for about, I think it was around an 8-10 month basing out period there. And you can see the 150-day moving average starting to flatten out a little bit. And actually the market was going sideways in such an oversold position there in 0203 that the market was actually in a position to break out above the 150-day, 150-day moving average in the beginning of 03, which signaled the beginning of the next bull run.
No, that's right, and it's like in the course thing I have on the website. That's kind of the very beginning of the course. I talk about that. That's when you really want to buy as an investor.
Yeah.
And there's some other indicators like the 200-day Bollinger Bands I like to use too, and they usually coincide with the breakout above that moving average because they come real close together. But it takes 6 months or maybe sometimes even a year of building that base after the bottom to get to that point. And that's what you saw in 2003. And you broke out above that moving average, and then that moving average acted as support until it topped out about a year ago. I guess you see that in your next chart.
Yeah. Well, right quickly, Mike, one more note on this chart on the S&P 500. When the market actually got in position in the middle till the end of 03, there's a couple of things, and we'll talk talk about this more later in this bear market here, because I figure that in about the middle of the summer of next year we'll be really starting to zoom in on this, depending on how the market shapes up. But one thing that's really important here in this position in 02 to 03 is that a lot of the sectors at this point are starting to base out. Well, there are some sectors still breaking down in 02 and 03, but there are a lot of sectors start lining up and start basing out into like a stage 1 formation. And that's a real good sign that, hey, the market's getting, half the sectors or half the market is getting in a position, the bear market in those particular sectors are over. And they're starting to look more, a healthier look about them. So the market's coming to an end. It's just when does it? And those are the sectors we're going to be, really concentrating on.
Yeah, for instance, you have a chart of eBay.
Yeah, at the very bottom of the charts. We can jump to that and we'll talk about it. Take a look at that chart, Mike, of eBay right there. It's at the bottom. This is a stock that in around 02, I actually bought this stock in a couple of accounts. And you can see that in 02, the market was actually still breaking down. Even going into 03, the market was breaking down. But eBay, and you could actually use your Bollinger Bands on this, on a monthly Bollinger Bands, they were actually pinching. I don't have them on this chart here, but that was one of the scans that I ran when looking in 02, because I know the market was starting to get in position because the advanced decline line was starting to flatten out, and we were starting to see, again, these are the indicators and some of the things that we will use, to determine that not only is, the market starting to base out at a lower level, but there are sectors that are getting in position, and some are even starting to break out, which is a good sign, which eBay was one of those stocks that broke out in 02, and you can see the percentages there were, they were huge. They were 400% or 500%.
Well, what happens is there's some sectors, that hold up and go through this cycle of bottoming and then turning to new bull market ahead of the rest of the market.
Exactly. That's exactly right.
And that's what we'll have to be on the eye out for probably, next year.
Yeah, and let's, a right quick note, we were just talking about, the bear market that we're in, that you see that we're in now. If you scroll down, I believe I have a chart. Yeah, I have a chart. The next one to the bottom, right before you get to the eBay chart. I have a chart of the S&P 500, and I think we're around 30%, 25 to 30, roughly, somewhere around there, percent away from the 150-day moving average. And even though we've fallen really hard, the market could actually rally here 15, 20%, take a couple months, come back and do a retest in 2-3 months, and then at that point you'd probably see the 150-day moving average starting to slip in, getting a little bit closer to the range that we're in. Now that doesn't mean it's time to buy or we're going to see a breakout, but we'll basically take a look at all the sectors that were across the market and just see how many of them are starting to look healthier, or if there are any sectors starting to break out, because basically you don't know if even if the market were to bottom today, and it were to rally for 2-3 months, that's the bottom of this market, and you should be piling in on a breakout, because that might not be the bottom, and the market might make another leg down and drop and go down another 10%. And that's the beautiful thing about using long-term moving averages. You'll never go long the stock market unless you're just making a little swing trade or something. I just don't feel that, you just don't go long this market until you see the market in a position, for it to break out and truly get above the 150-day moving average, and those long-term moving averages to curl under it and start going up, which, we will see that probably in the next 10 months to a year. This thing's going to really get in position. It's going to be a great buying opportunity.
Well, let's take a look at the other charts. You got one 1975 of the Dow?
Yeah, I got let's take a look at the
Because I guess if the market, assuming, let's say the bear market ended right now, I would assume that something like this will be what comes forward in the next couple months.
Yeah, well, here's in the 74 bear market here, the 73, 74 bear market. Now, this drop here is real similar to the drop that we're seeing today. This is stretched out over a little bit longer time period, but the percentages are around the same here. And we got the bottom there, and we jumped back up, and we came back, and we did a retest. And believe it or not, the Dow, and this is a real important. If you study stocks or in bear markets, the market here actually made a new low, but it didn't break down, and that was a big sign there that you make a new low, but you don't break down, and you're doing a retest that's spread out over 4 or 5 months, and then the market jumps back up and clearly breaks above the 150-day moving average. But Mike, when I look at this is a bear market that spanned 2 years, basically exactly. And we've been in this bear market about a year, and I guess we've been a year and a couple of months. So, and I'm not using a time frame because I don't think some bear markets like the 2000, 2003 was 2.5 years. This one was 2 years. Sometimes the market can go quicker and faster and get in a position to possibly go back up. I don't care about the time. I just want to see the stock market line up and get in a position and base out. But if you take a look at the bear market, let's jump over on the same chart, Mike. Look at the bear market of 69.70.
Right.
And this here again, this is a big bear market, and then we get this jump right back up to 150. One thing about it, every bear market came to an end with the market clearly breaking through the 150-day moving average and getting above it, and the 150 curling up under it. And you were going to see the same thing here. You don't have to try to guess the bottom. It's gonna line up for us, and it's going to be a great buying opportunity.
Well, we got one more chart, the 1929 to 32 bear market.
Yeah, here's another market. Which this took 3 years from top to bottom, and the percentages here were just enormous. I think they were 85%, 86% from top to bottom, but things were a little different then. Not to get into all that, but I would have bought this market. This market was a buy in the early part of 1933 when we had it finally had bottomed, it based out. Basically, it put in a bottom of about, 7 or 8 months. Had a little retest back in 1933, and then it breaks out of that little consolidation range there, and that would have been a buy and hold all the way into the early 40s, which I don't have a chart of it, but in the 40s there was another really.
Well, if you look at that, market. There's two things, if you would have done this, if you would have waited for the moving averages to do that, for the moving averages to flatten out and the market to get above them, you would have saved you a whole lot of grief, because I'm sure back then everyone was trying to guess the bottom all the way down, just like they have been here. But if you would have waited for that, of course, you would have gotten the exact bottom. That's a trade-off, but, I'd rather be able to save my money and buy in when things are good and not have to worry myself about what the market's going to do, knowing that it's going to go up, and you still would have made a killing, from, I don't know exactly how much it went up to, but from just 60 to 180 is 300%.
Yeah,
I know it went up more than that.
The percentages are enormous, but I'm glad you brought that up, Mike, because it's 2 points I want to make here. If you buy a stock now and you're holding it for the next, say, 6 months to a year because you think it's cheap, yeah, everything is cheap. The stocks are beaten down. Yeah, they're priced really low. Let's say a stock was trading for $90 and now it's a $10 stock. So you buy that $10 stock, and in the next, we don't know if this bear market's going to last 6 more months before it's trying to put in a bottom, or is it going to last another year, okay? Well, you're holding that stock. I've tried this. This is the second bear market I've been in, and I got really experienced, got a lot of experience in the 02, 03 bear market. So I learned this the hard way. You buy that, take that position at $10, and hey, it jumps up to 12, and you're looking good. Well, you know, nowadays, you know, bear market, if news comes out, Mike, it's always, most of the time, it's bad. So they come out and their earnings are bad, and you have some analysts downgrade it. You know what? It's down 45% one morning. I know you've had that happen before. So you're sitting here holding stocks, just allowing, you know, waiting. You know, all the news now is being sold. So, I mean, if something bad's coming out, you know, the stock's getting sold. And another thing is, we don't exactly know, let's say in 10, 12 months this thing is in a position and we're starting to scream, all right, we're getting ready to buy. We don't exactly know which sectors are the best ones to be in.
Well, I think that's a real important point, too, is you want to always be in the, you know, when you're going to buy when the stock market's going up, you want to be buying the sectors that are going to outperform. Because like your example of eBay on here, eBay held up and put itself into a good position, and it went from $10 to $46 in just 2 years.
Exactly.
I mean, that's a 400% return, which beat the stock market. But in order to find and identify the sectors and stocks that are going to outperform, you can't. In a bear market, you're not going to necessarily, and certainly not now, you're not going to get them by buying on the exact bottom of the bear market. You're going to have to let the market consolidate and show you what sectors are going to do that.
Mike, right here, exactly. Let me explain exactly how this will unfold. Let's say the market has bottomed. It tries to bottom in this range, and it rallies for 2 or 3 months, 10, 20%. On the retest, or if the market were to make new lows the first part of next year, retest or make new lows, that's when we're going to start running our scans on the sectors, because we're going to start zooming in on, if the market were to make new lows, well, which stocks didn't make new lows? Which stocks are now starting to enter a stage 1 basing out period when there's weakness in the market? That's the most important part of recognizing that the bear market is starting to get in. There are sectors that are starting to get in position, and that the bear market will end soon. And that's the same thing that you saw with eBay in 01, 02. That's what makes it the most important part, you know, going forward as far as trading is, I don't need to trade now. I don't care if the market's up 400 or down 400. When this thing lines up and gets in position in the next 6 to 10 months, we'll be able to recognize those stocks that are in those positions.
No, it's going to be exciting, but you know, to take advantage of it, people are going to have to be patient, and that's tough for people to do.
You know, Mike, you and I, we've traded a lot, and out of all the years I've done this, I've traded in 2 bull markets and 2 bear markets, and you know, I feel like I'm starting to mature just enough to take what I've learned and allow, you know, to have the patience and to be able to. I didn't do well in the 03, 04 bull market, and I've never done really great in the bear markets. I've never lost any money. I've made a little money in the bear markets. But it's like I'm getting to the point that where I need to start, you know, I know how this is going to come, you know, to an end. I know how it's going to get in position. And I'm more excited going forward in the next bull market, because I'm not going to make some of the mistakes of, hey, I'm buying in and I sell out too quickly and then I never get back in because the stocks go up, and, you know, 6 months later they're up 75%, 100%. And believe it or not, that's how much they move. You know, it's amazing when you can buy the right stocks coming out of a stage 1 breakout and the market is actually turning bullish, even though the economy might be lagging. And that's something people need to understand here going forward. Sure, the economy's bad. I mean, I'm about as down on the economy now as anybody, but the stock market will bottom ahead of all of this, you know, and it can surprise people. When things are, you know, looking as bad as bad as they can, the market can be putting in a final bottom, which we will not miss. And we're going to be all over that and be able to get invested in some great companies that are really beaten down with some really good dividends that are in our stage 1. And a quick note is I can already tell you that, believe it or not, I believe I went through the sectors about once a week, and I just flipped through them a little bit because it's a little early now. But I still look through them, and I believe the banking sector, the financial sector, is going to be one of the sectors that are lining up.
No, it certainly looks like, especially the regional banks and airlines actually.
Oh, yeah. Airline want money in them, but I'll put 10, 15% in each one of those sectors, and I'll try to pick out the best stocks with the best dividends and take a look at them, and and hopefully be able to pick up 200-300% return in the next, in 2-3 years. Mike, going forward, I've never been able in the early '90s to the '90s and everything. I made more money in that market, but I guess it was just kind of like dumb luck because I bought and held, and every time it pulled back, I just bought more. And I was just fortunate enough, after meeting you in the early '90s, and you opened my eyes a little bit, I was able to sell out at the top.
It worked out pretty good.
Yeah, it didn't take me long to realize.
Well, I hope we'll eventually we'll be buying at the start as the next big thing. So
we most definitely will, Mark.
We'll have to wait a couple months for that. Well, I'll let you go. I know you got to take off, but thanks for doing this, talking to everybody.
Thanks for having me, Mike.
Sure.